Hey everyone, and welcome to this explainer. If you've ever taken a hard look at your finances and wondered, how does life insurance actually work? Like, where exactly does the money go? How are the returns generated? And most importantly, are you making the smartest choices for your family? Well, you are in exactly the right place. Today, we're breaking down a really detailed analysis on a super popular yet honestly deeply misunderstood financial product, guaranteed return plans. We're going to completely strip away all that confusing marketing jargon, look straight at the hard math, and figure out what these policies are literally doing with your hard-earned money. Okay, let's dive into this because it's kind of the ultimate dream for pretty much every investor, right? You want life cover to protect your family, sure, but you also want a solid, reliable return on your investment. And more than that, a lot of people want this without taking any market risks whatsoever. Basically, they want something that acts almost exactly like a bank fixed deposit, guaranteeing a specific payout on a very specific date while also giving them an insurance safety net. But we really have to ask ourselves, does a magical product that perfectly balances high returns, literally zero risk, and adequate life cover actually exist? To answer that, let's just quickly walk through our roadmap for today. We'll start with the life insurance umbrella, then move to understanding guaranteed return plans. After that, we'll look at the math behind the guarantee, followed by hidden costs and coverage gaps. Then we'll figure out, is a GRP for you? And finally, securing your financial future. All right, let's kick things off with Section 1, the life insurance umbrella and understanding the baseline. So to really understand where guaranteed return plans fit into the whole market, we first kind of have to look at the broader life insurance landscape. It's this massive umbrella with a bunch of very distinct products sitting underneath it. Now, on one far end of the spectrum, we have term insurance. The industry calls this a pure protection plan. It's incredibly straightforward. Basically, you pay a very small premium, and in exchange, you get massive risk coverage. To put that into perspective, a young person might pay just 400 to 500 rupees a month to secure a whopping 1 crore in life cover. But, and here's the catch, the trade-off is that if you actually survive the policy term, you get absolutely zero returns. There's no savings component here at all. It's purely a safety net for your family. Now, way over on the other end of that spectrum, you have something like a ULIP, or a unit-linked insurance plan. This one's a hybrid. A small slice of your premium goes towards securing your life cover, but the lion's share is actually invested directly into the stock market or mutual funds. And because it's tied to the market, your returns are completely variable and unpredictable. You could see some truly great growth, or you could see your portfolio dip substantially if the market happens to crash. Let's move to and see how this builds into Section 2, understanding guaranteed return plans, the middle ground. So what if you just don't want the pure zero return expense of term insurance, but you absolutely flat out refuse to take the market risks that come with ULIPs? Well, that brings us right to the middle ground. Enter the Guaranteed Return Plan, or GRP. Now, the single biggest selling point of a GRP can basically be summed up in one word: certainty. These plans promise absolutely zero market risk. The returns are fixed, very much like an FD, but they also bake in that life insurance benefit. When you buy this policy, you're told exactly what your final payout will be on day one. For folks who prioritize capital safety over aggressive growth, that level of clarity is highly appealing for planning out long-term financial goals. Within this GRP category, the source notes that there are generally two main paths you can take, completely depending on what your end goals are. The first is a guaranteed income plan. Instead of giving you a massive chunk of money all at once when the policy matures, it gives you regular guaranteed payouts, either monthly or yearly, and some even offer this for your entire lifetime, which is pretty wild. Then, the second option is a guaranteed savings plan, also known as a lump sum plan. Here, you pay your premiums, and at the end of the term, you get one single large payout. This one's super popular with parents planning for a child's higher education or people aiming to build a very specific retirement corpus. Moving right along to Section 3. The math behind the guarantee, PPT versus PT. So how do insurance companies actually structure these products to guarantee those returns? Well, it all comes down to the internal mechanics. Now, what's really interesting about this slide is the huge difference between the premium payment term, or PPT, and the policy term, or PT. In a lot of GRPs, you have this limited pay structure. You might only pay premiums for, say, 5, 10, or 12 years. That's your PPT. But the actual policy term might be 20 or even 30 years. So even after you stop paying the company in year 10, your money just sits there. It continues to compound and grow, and your life coverage remains completely active. The final payout is calculated on that full 20 or 30-year time frame, which really allows the money to snowball over a long period.
And alongside all that compounding interest, these plans do offer a couple of extra secondary benefits. Naturally, there's a death benefit. If the policyholder tragically passes away during the active policy term, a predetermined amount is paid out to the family. Also, if you happen to hit a severe financial emergency midway through the term, you don't necessarily have to cancel the whole policy and lose your benefits. A lot of GRPs actually let you take out a loan against the accumulated value of the policy, which definitely offers a bit of flexibility when life throws you a curveball.
All right, Section 4, Hidden Costs and Coverage Gaps, Peeling the Onion. Up to this point, GRPs probably sound like the perfect financial product, right? But as we dig deeper into the sources analysis, we really need to peel back the layers here. Just think about it. To guarantee your return, the insurance company has to invest your money in very safe, very stable instruments, usually government securities and high-quality bonds. Now, these typically generate a return of about 6 to 7.5%. But here's the kicker. You, the consumer, do not get that full amount. Unlike a totally transparent mutual fund, a GRP has several hidden layers of deductions literally baked right into the pricing. From that initial 7.5%, the company subtracts agent commissions, administrative costs, mortality costs for the insurance portion, and, of course, their own profit margins.
So the crucial point is, after all those internal costs are completely stripped away, the actual internal rate of return, or IRR, that finally lands in your pocket usually hovers between a really modest 5% and 6.5%. Sure, the marketing brochure's 30-year projections look absolutely massive just due to the sheer math of compounding, but the actual annualized return is incredibly conservative. It's basically a staring contest with long-term inflation, and unfortunately, inflation rarely blinks.
And that actually brings us to the second major flaw highlighted in the source material, the coverage gap. Because a GRP merges savings directly with insurance, only about 5% to 10% of your premium is actually going toward buying life cover. The rest goes straight into the savings bucket. As a result, the life cover provided is usually capped at just 10 times your annual premium. So, if you're paying 50,000 rupees a year, your family's life cover is just 5 lakhs. Let's be real, in today's world, if tragedy strikes, 5 lakhs is just dangerously insufficient to genuinely secure a family's financial future.
Moving on to Section 5. Is a GRP for you? Making the decision.
Knowing about these safe but super modest returns and the heavily restricted life cover, does a guaranteed return plan actually deserve a place in your portfolio? Well, it is suitable for a very specific type of person. If you are highly risk-averse, completely avoid the stock market, and really just want FD-like safety with a tiny bit of extra insurance, it works. It's also used a lot by high-income earners who have already totally maxed out traditional tax-saving tools like PPF or EPF and just want another avenue for tax-efficient fixed returns, or maybe retirees seeking a guaranteed income stream. However, a GRP is emphatically not for you if you want high inflation-beating returns. It's not for you if you need liquidity, since your money is locked in for years, and most importantly, it is absolutely not for you if you are looking for primary, adequate life insurance to genuinely protect your family.
And finally, Section 6, Securing Your Financial Future, the source's recommendation.
So, if mixing insurance and investments leads to modest returns and totally inadequate coverage, what is the optimal path forward here? The source material offers a very clear alternative strategy, and this brilliantly illustrates the point. They suggest thinking of term insurance as your financial security guard. Think about it. You wouldn't hire a security guard and also expect them to manage and grow your stock portfolio, right? No way. You hire them purely for protection. Your insurance should act exactly the same way. It should stand outside your financial life purely to protect it, allowing you to use the rest of your money for dedicated wealth generation. Instead of paying a huge premium of 15,000 or 20,000 rupees a month into a GRP just for a tiny bit of life cover, the source recommends totally separating the two. You can secure a pure term plan for anywhere between 400 to 1,200 rupees a month, depending on your age, which grants your family a massive 1 crore to 2 crore in tax-free lump sum coverage if something happens to you. Once that unbeatable security net is locked in place, you are entirely free to take the rest of your money and invest it however you see fit, whether that's aggressively in mutual funds or safely in fixed deposits, without having it all locked up in a rigid insurance product.
Now, navigating the thousands of term plans out there can honestly be super intimidating, which is why the source highlights a service called Ditto Insurance.
Boasting a 4.9-star rating, Ditto is presented as a great solution for those who absolutely dread the usual spam calls associated with buying insurance. Their process is really structured. You just book a free slot at your own convenience, and an IRDA-certified advisor will reach out to you via call or WhatsApp. They offer tailored advice based on your budget and your family's needs, completely without the spam. Plus, they provide a dedicated support team that actually stands with your family to help process claims in the future, which is huge.
As we wrap up this explainer, I want to leave you with this question to ponder. Really take a hard look at your own portfolio. Are the insurance products you currently hold genuinely providing a massive protective safety net for your family in a worst-case scenario? Or are they just acting as forced savings accounts that offer modest returns while leaving your loved ones exposed to a dangerously massive coverage gap? It's an absolutely crucial distinction, and understanding it is the very first step toward true financial security. Thank you so much for joining us today, and as always, keep learning.